Welcome to Financial Insights in Minutes, where we summarize the day's top financial videos to save you time and keep you informed. Today, we're diving into some of the most pressing concerns in finance. Is the economy collapsing? We'll explore insights on market trends, potential recessions, and what's next for copper and gold prices.
You won't want to miss critical predictions on hiring trends and the bubbling concerns around the economy. What experts are warning about could be vital for your investments.
Let's jump right into the compelling viewpoints shared by various financial experts today. Ian Harris discusses the looming copper supply crisis and its global economic implications. Jeff Snider reveals serious declines in hiring rates, hinting at an imminent recession. Gary Wagner forecasts a bullish wave for gold amidst the current market uncertainty. Gretchen Morgenson exposes how private equity is damaging our economy and society. Michael Pento warns of 40% drops in real estate values due to bubbling markets. Steve Hanke predicts a recession in 2025 driven by contracting money supply. Craig Hemke assesses market volatility while analyzing small-cap stocks' resilience. Wayne Dahl reports on improving credit conditions despite recession fears. Welcome to the David Lynn channel on YouTube. Today, we're exploring the fascinating world of copper with Ian Harris, CEO of Libero Copper. Hold on tight as we navigate the currents of today's discussion on the looming global economic trends.
Indeed, Ian's insights will illuminate the complex factors affecting copper prices and their potential implications for the global economy. It's going to be quite the informative journey.
So what's the big picture being painted here by Ian Harris?
The core thesis centers on how copper prices are a reflection of broader economic signals, particularly linked to decarbonization trends and the global shift towards electrification.
Let's dive into the key points, beginning with the impact of decarbonization. What's that about?
Decarbonization is pushing demand for sustainable energy, requiring massive amounts of metals, particularly copper, for energy transmission and infrastructure.
How about the market dynamics affecting copper prices?
China's output greatly influences global copper prices, and there's widespread skepticism about the industry's ability to meet tight electrification deadlines due to limited supplies.
Interesting. What about copper as an economic indicator?
Copper's nickname is Dr. Copper for a reason. Its prices often reflect global economic health. Recent declines hint at possible economic slowdowns.
Now let's talk predictions. What does Ian foresee for copper prices?
Ian suggests that if market forces align, copper could soar to around $40,000 per ton, nearly 4 times its current level. However, that requires significant supply increases.
What are governments doing to help the copper situation?
Governments are starting to recognize copper as a critical mineral. However, short-term views might jeopardize long-term electrification goals without immediate action.
Let's peek into those predictions. What's on the horizon for copper supply?
Ian predicts an imminent copper supply deficit due to underinvestment, signaling the need for new projects to meet future demand.
Any predictions on how the economy will influence copper prices?
Yes, a global slowdown may push prices down temporarily, but increasing demand for electric vehicles will exacerbate the supply crunch in the longer term.
As we wrap things up, what's the final takeaway?
Copper's vital role in the future energy landscape cannot be overstated. The narrative of electrification is clear, and strategic planning is essential to prevent a looming supply crisis.
What should be the focus moving forward?
Stakeholders must prioritize strategic investments in copper projects to align with future demand and environmental goals. Time to put the pedal to the metal.
Welcome to Eurodollar University. Today, we're diving into some alarming news. Hiring in the United States has hit a slump that has experts scrambling.
Indeed, Jeff Snider discusses the latest hiring data, which reveals a steep decline with negative implications for the economy. Ready to crunch some numbers?
What's the crux of Jeff's analysis on hiring?
The thesis asserts that hiring rates have drastically fallen, signaling a deepening recession, contrary to what government reports claim.
Let's break down the key points. First up, what's shocking about the latest hiring figures?
Hiring dropped to just 5.4 million in June, the lowest since February 2023. Adjusted for population, the rate is below 2%, clearly recession territory.
What's the economic fallout of these hiring trends?
Well, McDonald's just reported its first negative same-store sales since 2020. Weak incomes mean less spending power, impacting sales across industries.
What's happening with job turnover?
That's the kicker. Quits fell to 3.28 million, the lowest since 2017. Folks are stuck, feeling there are no better options.
Looking ahead, what's Jeff predicting?
He foresees escalating unemployment rates and stagnating incomes, leading to even less consumer spending. We might be in for a tough ride.
Any signs of a consumer credit crisis?
Absolutely. Delinquencies are on the rise, and banks are pulling back on loans, making credit harder to acquire. Not great news for the average consumer.
To wrap it up, what's the main takeaway from Jeff's insights?
The labor market isn't just softening, it's in decline, and the escalating stress on incomes and credit may lead us straight into a recession. It's time to pay attention.
How reliable are those government reports?
They're certainly painting a rosier picture than reality. The data is telling us the economy is in decline, and Americans are feeling it firsthand. Something's got to give.
Welcome back to Kitco News. Today we're exploring a hot topic, gold's potential third-wave bull run. Joining us is the astute Gary Wagner, a renowned market technician known for his expertise in technical analysis and Elliott wave patterns.
Absolutely. Gary has a knack for breaking down complex market movements, particularly in gold, and his insights today promise to be enlightening. Buckle up.
So, what's the main thesis behind this bullish sentiment for gold?
The main idea is that gold is potentially starting a major third wave in its bull market cycle. Gary emphasizes that his previous predictions regarding breakout patterns have consistently been valid.
Let's dive into some key points. First, what are the latest figures on gold?
Gold is currently trading over $2,400 per ounce, and the upcoming FOMC meeting is crucial for the market's direction.
What about the Elliott wave patterns? What does Gary say?
Gary suggests that gold might be in wave 3 of a 5-wave cycle. Wave 1 serves as a benchmark, supporting a bullish outlook.
Interesting. What are the targets we should look for?
Short-term targets are between $2,460 to $2,490, while longer-term projections could see prices reaching up to $2,675.
So what's Gary's prediction for the future of gold pricing?
Gary anticipates that continued bullish sentiment could drive prices higher, especially with favorable FOMC announcements. Plus, corrections could provide great trading opportunities.
As we wrap up, what should traders focus on?
Traders should keep a close watch on market signals and timing to capitalize on this potential gold bull run. Gary's insights make it clear we need to be both cautious and opportunistic.
Welcome to Thoughtful Money. Get ready to navigate the currents of a conversation that's turning heads, the role of private equity in today's economy. We're diving into the latest insights from the brilliant Gretchen Morgenson, an investigative journalist whose work shines a light on hidden financial practices.
Absolutely. Gretchen, a Pulitzer Prize-winning journalist, has co-authored a thought-provoking book that examines how private equity impacts the financial landscape. She's here to give us an update, and believe me, folks, you want to pay attention.
What's the key takeaway from your conversation with Gretchen? What's at the heart of this issue?
The core thesis is that elite financiers manipulate debt and dubious practices within private equity to enrich themselves, often at the expense of the broader economy. It's a system where, quite frankly, the powerful are controlling the narrative.
Let's break down the main points from this discussion. What are the undeniable truths about private equity ownership?
It's shocking. Private equity owns 40% of our nation's emergency departments. Plus, we've seen an alarming rise in bankruptcies among these firms, leading to dire consequences for employees and patients alike.
And what about economic disparity? Anything noteworthy there?
Absolutely. A staggering 10% of households control 93% of all financial assets, showcasing a glaring wealth divide exacerbated by policy decisions that favor the elite.
Healthcare is always a hot topic. What's happening there with private equity?
The data is alarming. Nursing homes under private equity management see a 10% greater mortality rate, significantly harming patient welfare. This trend reflects a troubling decline in service quality.
Looking into the crystal ball, what predictions does Gretchen make?
She foresees a significant uptick in bankruptcies among private equity-owned entities as rising interest rates squeeze their financial models. This could lead to unfortunate job losses across many sectors.
And what about policy shifts? What's on the horizon?
With increasing awareness, we could see regulatory changes aimed at curbing the excesses of private equity, especially as public pension funds start scrutinizing their investments more closely.
So, to sum it all up, what are the vital takeaways from this discussion?
Gretchen emphasizes the urgent need for transparency in private equity and calls for fairer financial practices that prioritize the welfare of workers and consumers alike. It's time to demand change.
Welcome to the Julia LaRoche Show. Today we're navigating the turbulent waters of the economy with none other than Michael Pento, the president and founder of Pento Portfolio Strategies. Get ready for some fiery insights on the economic bubbles we're dealing with.
Excited to be back. Michael's expertise in macroeconomic trends is sure to enlighten viewers about the pressing economic issues we're facing, especially three significant bubbles that have emerged.
So, Michael, what's the crux of today's discussion?
The main thesis is alarming. We have a triumvirate of bubbles caused by 2 decades of negative real interest rates, creating a dangerous economic landscape that cannot last.
Let's dive into the key points. What bubbles are we talking about?
Right now, we see an unprecedented real estate bubble and an equity bubble, alongside exceptionally high levels of non-financial debt, surpassing 2007 pre-recession levels.
And how's it impacting everyday Americans?
The middle class is facing a serious squeeze with rising costs. Right now, 1 in 4 Americans is cutting back on food and medical care. That's a stark reality check.
What are the predictions about these bubbles?
The forecast is grim. Pento predicts that we may witness simultaneous bursts of these bubbles, potentially causing a 40% decline in real estate prices, along with serious repercussions for equities.
So what's on the horizon, according to Michael?
He predicts that the bubbles created by years of easy monetary policy are poised to burst, leading the economy into another deep recession.
And what about interest rates?
Interest rate cuts may not have the intended effect of stimulating the market, leading to a prolonged period of stagflation where inflation rises but growth stagnates.
So, what's the big takeaway for viewers?
The conclusion is clear. Without substantive economic reform that restores free market principles, the bubbles will burst and the repercussions could devastate the economy. It's time for action.
What should viewers focus on moving forward?
Viewers should be aware of the erosion of the middle class and advocate for stronger economic policies that support the majority, not just the elite.
Welcome back to WT Finance. Today we're diving into the troubling forecast of a recession in 2025 with Steve Hanke, a leading authority in economics.
Absolutely. Hanke's insights are invaluable, especially with his background in applied economics and global studies. Hold on tight, folks, as there's plenty to unpack.
So what's the crux of Steve Hanke's argument? What should we be bracing for?
The core thesis indicates a significant money supply contraction, leading to decreased economic activity and a likely recession coming our way by early 2025.
Let's sift through those key points. First up, what's the historical context behind this money supply contraction?
Right, the money supply in the U.S. is currently lower than it was back in July 2022. We've only seen this contraction 4 times since the Fed's inception.
What about the economic activity part? What's Hanke predicting?
He suggests that actual economic activity is set to soften further, while inflation is forecasted to stabilize between 2.5% to 3%.
And how are the central banks playing into all of this?
Hanke points to the Fed's quantitative tightening as a big part of the slowdown. Plus, many modern models don't even consider money supply.
What does Hanke foresee regarding the recession timeline?
Hanke predicts a serious economic slowdown by early 2025, stating the lag in money supply changes is key to understanding this.
Beyond the US, what about other economies? Should we be worried?
Yes, Hanke highlights that countries like China are also struggling with protectionist policies, potentially worsening their situations.
To wrap it all up, what's the key takeaway for our viewers?
The critical advice from Hanke is to keep an eye on the money supply, as it has a direct impact on economic performance and conditions. It's time to be proactive, not reactive.
Ahoy traders, welcome aboard the Technical Traders channel. Today, we're charting the unpredictable waters of the market, focusing on the magnificent 7 stocks. Joining for this tidal wave of insight is the captain of the ship, Craig Hemke. Ready to navigate through this market storm?
Indeed. With Craig's expertise in trading strategies and keen insights into market trends, he'll help untangle the confusion swirling around those big brands. Let's hoist the sails.
So what's the main thesis Craig's putting out there?
Craig's core thesis indicates a significant pullback in major stocks, contributing to market anxiety, despite notable buying activity in smaller stocks. There's a confusing disconnect in what's happening right now.
Let's unpack the key points. First up, what's going on with the magnificent 7 stocks?
The big names like Nvidia and Microsoft have pulled back sharply, creating a wave of fear across the market. It's a classic case of investors panicking when their favorites falter.
And what's the deal with the VIX?
The VIX is that fear gauge, and it's jumping due to intensive selling in those major stocks. When the big dogs struggle, everyone gets jittery.
What's happening in the small cap world?
Surprisingly, the Russell 2000 is thriving, pushing higher as big cap stocks falter. It's like a lifeboat amid a sinking ship.
Real estate seems to be buzzing. What should we expect?
Investors are flocking to real estate, hoping lower rates will revitalize the market. Homebuilder stocks are breaking out, but Craig warns against getting too comfortable.
How about gold and silver? Are they shiny and bright?
For now, they're struggling a bit due to broader market panic. When fear grips Wall Street, even safe havens can face turbulence.
Let's put the crystal ball to the test. What are Craig's predictions?
Expect more volatility. As conditions change, major swings might happen as investors scramble for clarity.
Anything specific about small caps?
Small caps are likely to stay in the limelight, possibly outperforming the mega stocks for a while. They could be the cream, rising to the top.
As we wrap things up, what's the takeaway?
Craig emphasizes the importance of staying cautious, monitoring the market closely, and protecting capital until things settle down. Let's ride out this wave together.
Ahoy there! Welcome to Blockworks Macro. Today we're diving into the depths of the credit markets with an expert navigator, Wayne Dahl of Oaktree Capital Management. With over $150 billion under management, Oaktree is a formidable force in investment strategies.
Absolutely. Wayne brings a wealth of knowledge about how credit conditions are shifting, especially outside the traditional banking system. The insights today will surely stir the waters for investors.
So what's the main takeaway from Wayne's insights? Are credit conditions really easing?
Indeed. Despite fears of a recession, Wayne argues that credit conditions, especially in the high-yield bond market, have eased. Factors like lower default rates and improvement in quality are creating a more favorable environment for investors.
Let's break down the key points, starting with the high-yield bond market. What's the scoop?
Yields are attractive, currently between 7.5% and 8%. Importantly, defaults have stayed low, partly due to a cleansing of weaker companies during the COVID crisis.
Interesting. What about the quality of the bonds themselves?
There's been a notable improvement in quality with more BB-rated bonds and fewer low-rated ones in the market, allowing for a healthier investment environment.
Did Wayne mention anything about refinancing trends?
Yes. There's seen a marked uptick in refinancing activity this year. Many companies are capitalizing on lower interest rates, allowing them to save on their borrowing costs.
Sounds promising. What about market resilience?
The U.S. economy is showing resilience despite recession predictions. The optimism in credit spreads reflects this sentiment, encouraging further investment.
Time for some crystal ball gazing. What are Wayne's predictions?
Wayne anticipates that the demand for private credit will grow, especially as companies look for financing options that suit current market conditions.
Any thoughts on economic recovery?
If interest rates decline, it could bolster the high-yield market, especially for sectors that have shown resilience amidst economic challenges.
So what's the bottom line here?
Wayne's insights indicate a more favorable credit market than many anticipated. Investors should navigate carefully and consider opportunities in high yield and private credit as the landscape continues to evolve.
In conclusion, today's videos covered key themes regarding the potential for an economic downturn, various financial bubbles, and the implications of copper prices. Experts like Ian Harris and Jeff Snider provided alarming insights into hiring slumps and the threats they pose to economic stability.
We also heard from Gary Wagner on the potential gold bull run and annual concerns raised by Michael Pento regarding market bubbles. While Steve Hanke's recession forecast for 2025 was sobering, a compelling narrative started emerging about the need for reform.
The varying perspectives highlighted not only the urgency of action in the credit markets and hiring sectors, but reinforced a pivotal need for transparency in economic practices. We hope you'll join us next time as we continue to navigate the intricate world of finance with fresh insights. Thanks for watching Financial Insights in Minutes for July 31st, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.